Good evening, everyone. This is Henry Gambell with SimplerOptions.com, and it's a nice free video. I wanted to give you a little bit of a follow-up here in IBM. So in one of the free videos that I had done last week, I was looking at IBM and looking mainly at the idea that I thought this rally was something that not necessarily that you wanted to short, but at the very least that you could fade. IBM has been pretty much straight up from this 130 level all the way into 150. And generally speaking, after such a strong run, either to the buy side or to the short side, a market is generally due for a pause. So I felt like that was one part of that, why to look at the idea of fading that 149 level. Then if you come back and take a look at the weekly charts, I feel like this always gives good perspective, because if you look at a daily and you're not quite sure about direction or what you'd like to do with it, stepping back to this weekly, and then just recognizing from a major previous swing high into a swing low, when we're sitting right there at that 618 retracement, it's another thing that suggests that this is a good area to pause and ideally consolidate, if not just roll back over. So we've got weekly resistance, and then we come back to the daily chart and say, okay, if you took that idea and you were working to short against 150, some of the best pieces of advice I can offer is first, start with something like half size. Give yourself the ability to have some leniency, so as this came up here and rallied, you're not sitting here panicking, but instead thinking, first off, I know I'm using a high probability strategy. I've got another chunk of my risk that I can add in if needed. And then when you do get this reversion, I always call the mean the 21 EMA, but this was pretty much the idea. Then when you do get that reversion to the mean, you're still able to make some money off of it, as opposed to panicking at the highs and getting out at the worst possible spot. So that's kind of a follow-through of how I was looking at it from there. What we do with it from here, I think there actually is a fresh setup on this. Now it's somewhat kind of intricate, I guess, because I think you have to do it exactly the way that I'm kind of looking at this. But the first thing I would point out is that you've got earnings that are coming up. Earnings, however, do not come up until the week after the April monthly expiration. So that still allows us to have these April contracts to work with. When I look at the chart, we know that we've got the weekly 618 that we've kind of held as resistance. Then on this pullback, we've held 149 as support. I was looking at it thinking, okay, maybe this would be better support. But then you come over and look at your open interest for these, and it's not huge. This will work a little bit better as you get closer to expiration. But look at the big chunk of open interest that we have right here at 150. That tends to make me want to think that that weekly resistance will hold, while also thinking that the 150 area will hold as support based off of the voodoo line, and in the end, consolidate near 150 into the monthly expiration. I like looking at this. It's not perfect, but I like looking at it for people with smaller accounts too, because anytime you have these dollar-wide strikes, you can really tailor your risk to be exactly what you would like for it to be, meaning the root of the idea is the short 150. Then you decide how much insurance you would like to buy. A bigger, more aggressive account could come down in here, or if you'd like to be more conservative, maybe you just do it 3 wide. The only problem, and why I said it's not perfect, is because once you get above 150, you start to go into $5 wide. So, for the sake of simplicity, and just to show what I'll be looking at to execute tomorrow and then take into next Friday, let's look at selling the Iron Condor. The 150 will be our short call strike, coming in and purchasing the 155 as protection, and then selling the 150 on the put side also, buying the 145 as protection. If you could take in a $2.80 credit on it, that's pretty solid. It's going to give you $2.20 of risk. Try to capture half of that premium into the monthly expiration, and I think that's the way we have to look at IBM at this point in time. So I hope you guys find that helpful. Have a good rest of your evening, and I will see you at the next free video.